Every empire swears its money is safe. Every government insists its promises will last forever. And every time, history proves them wrong. From Rome to France, from the Confederacy to modern Lebanon, people have woken up to find their savings worthless, their salaries meaningless, and their future stolen by systems they thought were unshakable. Collapse isn't rare. Collapse is the rule. The real question isn't whether financial systems will fall, but how you protect yourself when they do. The illusion of permanence is the most dangerous financial mistake. We look at our bank balances and our national currencies and assume they're solid ground, but money isn't bedrock. Money is trust, and trust can vanish overnight. That's why history is both brutal and useful. Every collapse leaves behind lessons and warning signs about what really preserves wealth and what turns to dust. And if you look closely, you'll notice something important. The survivors were never the ones who trusted the most. They were the first to doubt. Take the Byzantine Empire, often remembered as the eastern half of Rome that somehow survived 1,000 years after the Western Empire fell. At the heart of its economy was the gold solidus, so reliable that merchants across Europe, the Middle East, and Asia accepted it without question. For centuries, it came as close as the medieval world ever got to a global reserve currency. And yet, and longtime viewers will appreciate this, after the disaster of Rome's silver denarius, you'd think they would have learned. Roman emperors had diluted the denarius until it was basically tin with a silver coating. We've told that story before. But no. Centuries later, the Byzantines repeated the same mistake with gold. They began shaving its purity, thinning it out, mixing cheaper alloys in. At first, no one noticed. Then trust wobbled. The coin that underpinned Mediterranean trade became just another political invention. As its value slipped, its credibility collapsed, and with it, so did the stability of the Byzantine economy. So what survived? Not the paper promises or imperial decrees. The merchants who held real gold or land outside the empire's reach were the ones who kept their wealth while everyone else watched theirs evaporate. Here's the first timeless lesson. Governments cannot resist the temptation to dilute their money. And when they do, real value flees into assets they can't imitate. But collapse doesn't always come from rulers tinkering with currency. Sometimes it comes from shocks no one expects. In the mid-14th century, Europe was devastated by the Black Death, the deadliest epidemic in its history. Between 1347 and 1351, half the population died. Cities emptied, villages disappeared, trade routes fell apart. And yet, the economic story isn't just destruction. When half the workforce disappears, labor becomes precious. Survivors can demand higher wages. Food and land, once scarce, suddenly become abundant compared to the number of people left to use them. Families with liquidity, silver, goods, or simply the ability to work, found themselves holding unimaginable power. Land that was once expensive became cheap. Houses were abandoned. Fields lay unplowed. Survivors were shopping in a buyer's market. If this sounds uncomfortably familiar, it should. We saw a modern version during COVID. Supply chains collapsed. Governments printed trillions to keep the machine running, and inequality surged. Those with liquidity bought assets. Those living paycheck to paycheck were left behind. U.S. housing prices soared. The stock market snapped back almost instantly, while millions struggled just to pay rent. History rhymes. Pandemics redistribute wealth. Survivors of the Black Death climbed the social ladder by exploiting scarcity. Survivors of COVID bought the properties, stocks, and businesses others could no longer afford. It's not comforting, but it's true. Crises reward those with reserves and punish those without them. And if pandemics show how fast shocks can upend an economy, then the banking collapse of Renaissance Florence shows something equally vital. Institutions that seem too powerful to fail can topple like dominoes. In the 1340s, Florence was Europe's financial capital, home to giants like the Bardi and Peruzzi banking families. They had lent enormous sums to kings, most disastrously, to England's King Edward III during his wars with France. When Edward stopped repaying, the banks collapsed. Depositors were ruined. Trade froze. Florence plunged into chaos. What did people learn? The lie of too big to fail is as old as finance itself. Institutions exist to profit, not to protect you. When they go under, they take your savings with them. This lesson repeats across centuries, from Florence's collapse to Lehman Brothers in 2008, to Lebanon's frozen accounts in 2019. Survival belongs to those who understand that an institution's promises last only until the day they aren't honored. The American Civil War is remembered for its battles, politics, and the end of slavery, but beneath the gunpowder and speeches was a brutal financial war most Americans barely understand. Both the Union and the Confederacy discovered that a conflict of that scale requires printing money. In the North, the government issued greenbacks, paper money backed not by gold, but by the promise of the United States. At first it seemed bold and patriotic, but the more greenbacks poured into the economy, the less they bought. Inflation ate away at value. Confidence eroded. In the South it was far worse. Desperate for resources, the Confederacy printed astonishing amounts of currency. By the end of the war, inflation hit almost unthinkable levels, prices rising thousands of %, wages buying nothing. Soldiers' paychecks were worthless before they could even spend them. Families carried bags of money that wouldn't buy a single loaf of bread. By 1865, Confederate money wasn't weak. It was dead. What mattered in this collapse wasn't the paper promises. It was tangible things. Land, food, gold, anything real, held its value while money became a cruel joke. For ordinary Southerners, it was devastating. Lifetimes of savings turned into dust. For opportunists with access to real goods, the war became a chance to buy property and wealth for next to nothing. Here's a forgotten American lesson. Your country has already experienced a monetary collapse, and when it happened, no one came to rescue savers. Value didn't come from mistrusting the paper in your wallet. It came from owning something the system couldn't inflate away. France offers another brutal example of how revolutions can destroy money faster than wars. In the 1790s, after overthrowing the monarchy and seizing church lands, revolutionaries issued a new currency, the assignat. It was theoretically backed by confiscated land and meant to stabilize the economy. Instead, the government printed it endlessly. Each new batch devalued the last. Prices soared, wages didn't, and soon the assignat was worthless. Farmers refused to sell food for paper, demanding silver or goods instead. Bread riots returned. The revolution cannibalized itself. Those who survived weren't the patriots holding government paper. They were the ones who held food, gold, or property, things the state couldn't print. Fast forward 2 centuries, and the lesson reappears in Asia. In 1997, a speculative attack on the Thai baht spiraled into a regional financial crisis. Thailand had borrowed heavily in dollars, believing the exchange rate would hold. When it didn't, foreign currency debts became impossible to repay overnight. Investors fled. Currencies in Indonesia, Malaysia, and South Korea collapsed in a chain reaction. Economies shrank, unemployment soared, governments begged the IMF for help. The ones hurt most weren't the hedge funds that triggered the panic. They were ordinary people, savers watching their money lose value, homeowners whose mortgages doubled, workers who lost everything. And yet the pattern is painfully familiar. Those holding dollars or assets abroad survived far better than those who trusted local currency. A local collapse became a global wealth transfer, with Wall Street firms buying Asian assets for pennies on the dollar. This lesson echoes from Byzantium to Argentina. Borrowing in someone else's currency is a death trap. When the storm hits, the borrower drowns, not the lender. Now the picture should be clear. Whether it's revolutionary France, the American Civil War, or modern Asia, the themes repeat. Paper money collapses, debt chains nations and families, and survivors are never the ones who trusted the system the most. They're the ones who spotted the cracks before anyone else. And collapse isn't ancient or far away. It's happening now. From 2019 to 2021, Lebanese banks did something almost unimaginable to people in the developed world. They locked their doors. Citizens woke up to find their deposits frozen, withdrawals limited, and their money evaporating in real time. The Lebanese pound lost over 90% of its value. Lifetimes of savings became pocket change. People stood in line outside banks, begging for access to their own money, only to be told it was gone. And this wasn't just small savers, middle-class families, retirees, engineers, doctors. Anyone who trusted the system was wiped out. The lesson was brutal and unmistakable. The money in your bank isn't a treasure chest. It's a loan you've given to an institution that may decide, in a crisis, not to give it back. Those who survived best were the ones who had diversified abroad, held real assets like gold or real estate, or kept cash outside the banking system. Everyone else was trapped. If this feels distant, it shouldn't. In 2008, Americans watched their homes foreclosed, while the banks that caused the crisis were rescued. In 2020, trillions were printed, saving asset prices while wages stagnated. In 2023, regional U.S. banks collapsed almost overnight as depositors lost confidence, reminding everyone that too big to fail is a fairy tale we tell ourselves, right up until the doors close. So how do you protect yourself when everything collapses? History shows there's no single answer. In Byzantium, it was gold. After the Black Death, it was liquidity to buy abandoned land. In Florence, it was refusing to trust bankers who seemed invincible. In the Confederacy, it was durable goods. In France, it was food and property. In Asia, it was avoiding debt and foreign currencies. In Lebanon, it was getting out before the banks froze. The patterns change, but the theme is constant. Survival doesn't come from blind faith in paper or institutions. It comes from understanding real value before illusions crumble. And here's the paradox you need to wake up to. Collapse is both tragedy and opportunity. For the unprepared, it's destruction. For those with resilience, liquidity, or unprintable assets, it's a moment of acquisition, wealth selling at a tiny fraction of its former value. After the Black Death, peasants became landowners simply because there was too much land and too few people. After 2008, those with cash bought homes as millions faced foreclosure. History shows that preservation is not just about defense, it's about positioning yourself to acquire what others are forced to surrender. But wealth isn't just what you own, it's what you can do. Survivors weren't just people with gold or land. Survivors were those who could provide value when others couldn't. The baker who could still provide bread, the craftsman who could repair tools, the farmer who could feed a community, the merchant who could move goods across borders. These people didn't just survive collapses, they rose during them. In every crisis, money loses meaning. Production never does. People still need to eat, build, trade, and live. And those who can meet those needs never stay poor for long. This is the deeper kind of protection. Not blind belief in institutions, not hope that governments or banks will save you, but a combination of real assets, real skills, and an awareness that illusions always collapse. Every crisis is a transition, from the trusting to the prepared, from paper promises to tangible value, from passive savers to active builders. History has shown this pattern over and over. So the question isn't whether everything will fall apart. It always does. The question is whether you'll be the one holding promises or holding something real. History doesn't repeat, but if you ignore it, it will crush you anyway. If this gave you a new perspective, hit that subscribe button. History has answers, and I'll show you where to look.